Hello, this is Group 9 Market Update Presentation. Our team members are Katie Buda, Natalie Lam, Rodrigo Silva, and Ragnil Stewart. We observed a large number of financings activity by companies over the period starting on March 14th until March 28th. We would like to highlight two high-profile season equity offerings from General Mills, who raised $1 billion in equity, and Overstock.com, who raised $180 million in equity. On the IPO scene, we would like to quickly mention Dropbox's big IPO of $756 million. On the first trading day, shares rose approximately 40%. Lastly, we would like to highlight Anheuser-Busch, the beer company, raised $9.5 billion in debt through bond issues, and Sprint raised $4 billion through the same mechanism. On the mergers and acquisitions scene, Bloomberg reported activity on a whopping 1,232 deals in the same period. This number includes a total of 551 announced deals and 555 completed deals around the world. A major deal we looked at was the acquisition of MuleSoft by Salesforce.com, announced on March 20th. The total value of the deal was $5.6 billion in cash and stock, and the valuation represents a premium of 38% over the last closing price of MuleSoft. The EV to revenue multiple was 19 times, and the rationale behind the acquisition is that MuleSoft platforms for application integration is a perfect ecosystem for Salesforce new product, Salesforce Integration Cloud, which will allow customers to seamlessly access enterprise data in a secure way, regardless of where the data resides. The next deal was Plantronics acquiring Polycom today on March 28th. The total transaction value of $2 billion will be paid out in cash and stock. This represents a victory for private equity firm Ceres Capital Group, which found a lucrative exit for their investment. The rationale behind the acquisition is strengthening Plantronics' offering by adding a leader of the voice and video collaboration market. Now we'll review some major economic news. During our period, the Federal Open Market Committee met to decide on the outlook of the economy. The Fed decided to raise the federal funds rate by 25 basis points, from 1.5% to 1.75%. And expected more rate hikes throughout the year. The Fed also restated their view of a strengthening economy, supported by the revised core personal consumption expenditures to 4%. The next day, the monthly jobless claims report came out reporting slightly above consensus, but still at a very low level. The Manufacturing Purchasing Managers Index came out at 55.3, slightly below consensus, but still at a strong level. Finally, the Consumer Confidence Index came out on March 27, at a level of 127.7, below consensus, but also very strong.
GDP numbers were released today on March 28th. There was a 2.9% growth in Q4 of 2017, which was driven by the biggest increase in consumer spending in 3 years. Overall, 2017 saw 2.3% growth in GDP, and this is projected to grow faster in 2018 due to low unemployment and the recent tax cuts. The markets have been a bit volatile in the last few weeks, and after the Dow and S&P fell significantly on Friday the 23rd, they went a little back up on Monday. However, there's still definitely a lot of movement and volatility. And the closing values as of today on the 28th are as follows. The Dow Jones is at 23,848, S&P 500 at 2605, and the Nasdaq at 6,949. Here's a graph showing the market returns in the month of March. As we can see, it definitely took a pretty big hit in the last few days, but it's coming back up. We'll see what happens. Over to regulatory developments. The European Commission proposed new rules on how they will tax tech giants like Facebook, Google, and Amazon. The most dramatic is a temporary measure that would add a 3% tax on revenue generated from digital activities, which includes online advertising and the sale of user data. This tax would apply to companies with global revenue of more than 920 million, and according to an estimate from the European Commission, this tax could potentially add $6.1 billion a year to the member countries. The second measure, which the Commission describes as its preferred long-term solution, would tax digital profits where they are generated. This tax would be applied even if companies do not have a physical presence in the country, and it could potentially make a huge difference in these companies' profitability. Over to tariffs. The president is planning tariffs on $60 billion worth of Chinese goods, in part because of alleged Chinese theft of intellectual property, which means design and product ideas. The White House said it has a list of more than 1,000 products that could be targeted by tariffs of 25%, and Mr. Trump wants to cut the trade deficit with China, which is a country he has accused of unfair trade practices since before he became president. These news followed the president's announcement in early March of a 25% tariff on all steel imports and 10% on aluminum, which led to dismay even among traditional U.S. allies. And then there's the new tech regulation. So Silicon Valley has been enjoying a regulatory exceptionalism, but this might be up for change after Facebook had a scandal in March where user data had been leaked. Following the scandal, Mark Zuckerberg, who is the CEO of Facebook, said to CNN, "I actually am not sure we shouldn't be regulated," which will no doubt be taken as we need the government to step in. Additionally, Tim Cook, who is the CEO of Apple, explicitly requested more government-mandated rules.
The first thing I want to discuss is investment banking news. Recently, JP Morgan, Bank of America, and Citi announced they are developing a new platform to overhaul the disjointed bond issuance processes. The Financial Times reports that the three are considering an online-based application that can be installed on investors' computers or one that is integrated through an application into existing asset manager order systems. The move, which is meant to solidify their hold on bond issuances and cut costs, could spell the end of sales team and corporate bond issuances. Deutsche Bank is still on the hunt for a new CEO. After the significant drop on the stock year to date, and despite a short tenure, the bank is looking to replace current CEO John Cryan. The role was offered to Goldman Sachs International Vice Chairman, but it is reported he turned it down. After a report on gender pay gaps emerged in the UK, as required by regulators, the banks promised to overhaul their hiring practices to improve working conditions for women in the country. Here is a breakdown of the IPO activity during our time period. The chart of deal count by region shows that we observed the most activity in North America, closely followed by Asia and Western Europe. However, we observe on the aggregated IPO value charts that the biggest deals occurred in Western Europe. The last chart is transaction value in millions, with a count of 67 in the bracket of 0 to 100 million, with a value of 1.3 billion. The second bracket is 100 to 500 million, has a count of 13 with a value of 2.39 billion. The last bracket is 500 million to 1 billion with a count of 1 and a value of $980 million. I would like to highlight the largest IPO, Dropbox. First trading date was March 23rd, trading price is 21, filing amount is $720 million US, and shares offered is 36 million. For new debt issues, McDonald's amount is $1.05 billion. It was issued on March 14th, 2018. The maturity date was March 1st, 2047. Spread is positive 137 basis points. Bookrunner joint leads unspecified. Credit rating Moody Baa1. S&P is BBB-. For number 2, we decided to go with Sprint Spectrum. The amount was $2.1 billion. It was issued on March 14th, 2018. Maturity date was March 20th, 2025. Spread is 212.5 basis points. Bookrunner joint leads. Credit rating Moody says Baa2. Third is Macquarie Group with the amount of $500 million. Issued on March 19, 2018, maturity is March 27, 2029, with a spread of 180 basis points. Bookrunner joint leads. Credit rating Moody says A3 and S&P says BBB.
We have observed that global markets are currently experiencing increased volatility as a result of multiple factors. First, fears of a global trade war have unsettled the global markets, but worries have now eased. Second, the president of China visited with Kim Jong-un, and equities in Asia are expected to strengthen as tensions ease in regards to North Korea. Third, although worries have eased in regard to trade, concerns still exist about the U.S. tech sector. Tech stocks declined on Tuesday after bursts of bad news surfaced about specific tech companies such as Uber, Facebook, and Tesla. Asia, stocks have experienced a decline after U.S. stock indices closed even lower. There are various events that have impacted Asia's markets this week. First, tech stocks in South Korea and Hong Kong fell amid the broader decline in the market. Second, the Trump administration had considered limiting Chinese investment in technologies that are regarded as sensitive. Third, the yen, which is often attractive in times of market turmoil and political tension, pulled back its gains against the dollar. In the US, stocks traded in and out of negative numbers on Wednesday, with the S&P fluctuating 59 times on a minute-by-minute basis. This volatility came as investors gained positive data on US economic growth while digesting news of the damaged tech sector. Additionally, US investors have calmed in regards to trade sanctions. In Europe, stocks closed lower Monday after the US and several EU nations expelled Russian diplomats in a show of solidarity with the UK. European markets also followed Wall Street's rebound on Tuesday after there were reports the US and China were negotiating to avoid a trade war. The market rebound is partly backed by a jump in casino share prices after a partnership was announced with Amazon. This rebound signals that volatility is returning to the market. With dry powder piling up across the industry, many of the industry's biggest names continue to strike 11-figure deals. The latest example is the Carlyle Group, which has agreed to acquire the specialty chemical business of AkzoNobel. AkzoNobel agreed to the deal to avoid a hostile takeover from its rival PPG. The deal is expected to be finalized before the end of the year. In hedge fund news, Alan Fournier, hedge fund manager at Pennant Capital, is returning client capital after 2 decades in operation. The liquidation comes after 4 years of disappointing returns. Fournier is a long-short stock picker and, like many other hedge fund managers, has found it difficult to profit with persistently low interest rates and the rise of passive investing. Fournier plans to return most of the fund's capital to investors by the end of April. We would like to thank you for your time and hope you enjoyed our presentation.